Welcome to another episode of the Washington Retirement Planning Podcast. I'm your host, Ethan Meikle, and here we talk about all of your amazing Washington State retirement benefits, best ways to utilize them so you can retire earlier and pay less in taxes. Today we're talking about 3 different ways that you can still save for retirement on a Roth basis, even though your income is too high. So if you're doing a Roth IRA and now you're not able to because you're earning too much from work, what are your options? We're going to go over 3 different ways they can still put money away and get that tax-free growth that you've been after. After that, we're moving on to today's question, which comes directly from the Washington Breakthrough Group. If you're not a member there yet, feel free to click the link in the description or show notes below to join for free. It's a community that has free courses and resources, all built for Washington State employees to help support your journey to retirement. So the question that comes directly from that group today is they're asking specifically about TERS 3 annuity options. So someone in Plan 3 that's looking, what can they do with their money? They're looking at annuities, they're not sure which one to use, and they want to know, which ones make sense, guidelines, and best ways to use them. So we'll cover what options you have with that Plan 3 money in general, as well as what specific annuity options should you be considering. Now, when you're saving into your Roth IRA, you can only be contributing into that up until you hit a certain income threshold, and that threshold changes every year. So for 2025, which is coming to a close here soon, for a married couple, you start phasing out $236,000. For single filers, it's $150,000. So up until you hit that point, you can still do the full Roth IRA contribution every single year. Once you go past that point, you're now in the phase-out range, which means for every $1,000 or so you go over that threshold, we can only put in so much less. So if we go $1,000 over, it might be $500 less. There's a chart that shows you exactly how much over you can go and what's your maximum contribution to be. So if you go over those numbers, it doesn't mean you can't do anything. It just means you can't do the full amount. And then the absolute top end range is the income threshold when you pass where you can no longer do it anymore. So that threshold for married couples sits at 246. So 236 and under, you can do the full amount. And 236 to 246, only $10,000 window is all you're allowed to do when they start decreasing the most you can contribute. After that point, you can't contribute anything. Single filers, it's 150 to 165. So if you are past those higher thresholds, Roth IRA is no longer something we can do anymore. What are our next best options? Option number 1 you should be considering is through your employer. So go ahead and ask them if they have any type of retirement accounts that allow Roth. So Washington State employees, Deferred Comp, a few years back, added Roth as an option. So you can do a deferred compensation plan as a Roth currently, and that has no income restrictions to it. So it doesn't matter how much money you make or how much money your spouse makes, you can always use and save into your deferred comp, either on a pre-tax or a Roth basis. The thing with this to know is whatever the annual limit is, that is the limit for both sides. So if they say, hey, the limit is $24,500, which is what it's going to be in 2026, the $24,500 can be done either on all pre-tax side, all Roth side, or a combination of both. You just can't exceed that limit. So you can put in up to $24,500, 3 times the limit that you could be putting in the Roth IRA into a Roth Deferred Comp. Now that's only up until age 50. Once you pass age 50, now you get catch-up contributions, which are now going up to about $8,000. So you can do another $8,000 on top of that into your plan. So $32,500 is what you're allowed to add into your deferred comp. So as long in the year you turn 50 up until the year you turn 60, that's now your new catch-up range. And then this Secure Act that passed now has another loophole in there where people age 60, 63 can do an extra $11,250, I believe, on top of the normal contribution. So the normal contribution is $24,500, you add $11,250 to it, and that's your new limit for the year. However, after you pass age 63, it goes back down to the normal catch-up. So the way it works is you're allowed your standard contribution, $24,500, up until 50. Then you can do another $8,000 or $32,000 or so up until 60. Then you go for 3 years. You can do $11,000 top of the 24. So now you're at $35,000. For the year, for 3 years, and then that 35 comes back down to 32 again once you turn 64. Now, of course, there's cost of living adjustments along those ways. Those numbers will not be like that forever. It's only for this year. Just know how the math works out. So if you're making too much for a Roth IRA, anything you have through your employer, whether it be the Roth Deferred Comp, Roth 403B, Roth 457 plan, Roth 401k, is always eligible for you to contribute regardless of your income. Option number 2 is going to be Roth conversions. So you can always convert, which says if I have money saved that's pre-tax, I can move it over into a Roth account. That has no income restrictions. Anybody at any age can do that. Doesn't matter if you're employed or not. As long as you have money sitting in a pre-tax account and they allow Roth conversions, you can do that anytime you want to. Roth DCP allows anytime you want to. You have money in an IRA at some brokerage account, that's easy. IRA is the easiest one to do a Roth conversion with. 403Bs, bit of a gray area. Technically, I guess you could. I don't know too many employers that allow it or any vendors that actually know what that is, has the paperwork and the staff to help you do that with. So I'm not saying you can't be done. It's a little difficult because it's kind of a new area for them. There's not a lot of people doing Roth 403Bs to Roth 403Bs. Oftentimes people just move those into their own IRA accounts and then convert. So I'm not saying it can't be done. It just may be difficult or the infrastructure may not be there yet. The DCP with the state, very easy to do. You just got to fill out the paperwork. The thing to know before you convert is you have to pay the taxes on whatever you convert, and you want to do so on a timely basis. So if I'm doing a conversion in March of a year, I want to make sure I make an estimated payment before the end of the quarter. On April 15th, I should make my first estimated payment for whatever that conversion amount is. You shouldn't wait until next April during tax time to say, hey, I converted this thing back in March. I think I owe you guys some money at that point. You risk potentially paying a late fee to the IRS. IRS is like us. They want to get paid on a regular basis. If someone owes you money in March and they make you wait till April, you're probably not going to be too happy. IRS is the same way, so they assess these late fees. So if you are doing conversions and you are having taxes withheld from them, make sure you make estimate payments on a timely basis. The other thing to know is when you're doing the estimate payments, it's important that you pay out of your own pocket and do not have it withheld from the account. The reason being is if I do a conversion of say $10,000 from my DCP to my Roth DCP account and I figured I'm going to owe $2,000 in taxes on that, I can't say, hey, I'm going to convert $10,000, send $2,000 to the IRS to cover my tax bill, and the remaining $8,000 go to the Roth. DRS does not allow that at all. So it's not even an option you can do regardless of age. You cannot do that inside the Roth DCP. Other accounts outside of that might let you take that option. So if you do this on your own through an IRA, that could be an option you could do. However, if you are under age 59 and a half, the tax withholding that you send to the IRS counts as a distribution, which then triggers a 10% penalty. So it counts as income and you get penalized for that purpose. So it's going to cost you a little bit extra. Once you're over age 59 and a half, you can do this without a problem at all. There's no 10% penalty. So under age 59 and a half, typically it's going to be more efficient to just pay the taxes out of your own bank account and make an estimated payment. Now, the third way to get money into a Roth IRA if you're making too much money is through something known as a backdoor Roth contribution. So I see this one come up more often than I really should. There's some people out there that do these backdoor Roth conversions because their advisor told them it's a good idea and they never ever thought about converting money first. They never used their Roth DCP first or Roth 403B or even looked if Roth is good to begin with. They just hear these terms and figure if they're going to pay me a fee, I should do this work. And they pull these levers and triggers. And it's really not the best thing for the client. There's easier ways to get money into Roth than the route they go with. The reason I think they do this is they're trying to justify their fees. If you go with the Roth DCP, they're not getting paid anything. Whereas if you do a backdoor Roth and they're managing the money, they get paid a little bit more for that. So be careful when people recommend backdoor Roth IRAs unless you've exhausted all of your other avenues first. Now they can be good. You can do them on top of your other Roth accounts. So you can do Roth DCP and a backdoor Roth IRA. It's just important to know the reasons why you're doing it and which account you should be doing first. Now, the reason I'm not real big on backdoor Roths unless you exhaust those other options is they're just a little bit trickier to do, especially if you're doing it on your own or with an inexperienced advisor that doesn't review your taxes. Because every time we touch our money or make transactions, there's going to be a tax consequence. Just like with the Roth conversion, when I do a backdoor Roth contribution, there's going to be some tax forms that get filed and there's tax consequences that you'll be hit with. Many times it's years after the fact, unless you follow the proper steps. And I've yet to see one come across my desk from another advisor that told their client to do that has actually followed the proper steps. To back up a little bit, backdoor Roth IRA is when you start making over the threshold. We can no longer do a Roth IRA anymore. You can still do a traditional IRA, but those also have income limits. So the contribution that goes in there is considered non-deductible. So I could do my, let's say, $7,000 contribution into a traditional IRA, pre-tax IRA. it's considered non-deductible. So it does nothing for my taxes. It's just like putting in a savings account. But now that it's inside an IRA shell, I'm now eligible to do a Roth conversion. So you put $7,000 in an IRA, does absolutely nothing for your taxes. You convert it into a Roth IRA, of course, have to pay taxes because, again, this is a conversion on the money. Once it's in the Roth IRA, you can be invested and square away. The tricky part is when you're doing this, you got to make sure you don't have any other IRAs because they have a pro-rata rule, which can really throw off how they calculate taxes owed on it. And most importantly is you have to file Form 8606 on your tax form, which reports that you've made a non-deductible contribution into an IRA. If you don't file this form, the IRS is going to be like, hey, where did this money come from? How did you put this money in here? We don't have any paperwork on that. And if they don't have that paper on file and they see now you have money in a Roth, they're basically going to think that you put money in a Roth, even though you're over the income limit. They will consider you as doing an excess contribution or ineligible for Roth contribution, and they assess penalties that apply every single year until you remove that money. So even if you follow the steps properly, if you don't show your work or and send the right paperwork in, you might be hit with penalties. And it might take the IRS some time to catch it. So like I said, you can do it away for a couple years and maybe get by for a little while. Eventually, though, they're going to catch it. You're going to just get these penalties or get a mean, nasty letter from them, and you're going to have to try to figure it out, and it's really hard to undo stuff and explain to them, and it's a long draw process that doesn't work out. And I've seen this happen a few times now when other advisors recommend this, but they don't do the tax planning, they don't review the tax forms, they don't double checking for this form, and it's something that the clients have to deal with. Recently, I had a couple come through who had an advisor that told them to do this. I checked the tax return, their tax form wasn't in there. They asked their CPA. The CPA said they filed it. And when I say, hey, where's the form? There is no form. But the CPA is adamant they filed it. Clients believe CPA. I don't have the form. I think we have an issue here. So they've yet to find that out yet. But unless the form does exist somewhere and they just didn't give it to me, they might be in for a rude awakening one day. And it's going to be up to the CPA and the advisor, who clearly aren't communicating, to figure out how to fix that issue. I just kind of sounded the alarm here as a potential problem coming from the future. And we essentially nix any future recommendations from that advisor to do that type of stuff until they start actually doing the tax planning and talking to the CPA. And we said we shifted into using the Roth TCP. It's a lot smoother. They didn't know the option existed. The advisor never told them about it because, of course, they're not getting paid. So they're not going to tell you what they aren't going to get paid on. So just because you're an advisor that you like and trust, it's always important to make sure you figure out, kind of follow the money. Is the recommendation really the best thing for you? Are there any alternatives? That's why it's important to work with somebody that specializes in watching the employee that doesn't just also work with them, because your guys' benefits are very specific and they change constantly. And if someone's not doing stuff with the state benefits all the time, they just do a few clients a year, they're going to mess things up like this. So if they also work with, doctors and contractors, things like that, and some teachers versus some firm that specializes in teachers, there's going to be a lot of things that slip through the cracks that you're not even going to realize what you missed out on until it's too late, or if at all. So backdoor Roth IRAs are a good strategy to use. Just make sure you follow the proper steps and turn the right forms. And if you're paying someone for your taxes and you're only paying like $100, chances are they're probably not the one you want filing their taxes for. At some point, it's important to pay person for what they're worth. So if you're going to pay for someone to do your taxes, make sure it's a licensed CPA that understands these type of strategies and the correct forms to process, and it isn't just a tax preparer. It costs about $18 and maybe less, a couple hours, for anyone in the country to become a licensed tax filer or preparer, so that it can legally go out there and charge people money to file their taxes. So the entry point is very low. So be careful who you use when you're filing your taxes, because just because they have a license to be a tax preparer or filer for you doesn't mean it's someone you should necessarily trust or use right off the bat. I would steer more to firms that have been around for a while, that have track records. Ideally, you're looking for a CPA. And yes, they're going to charge a little bit more, but oftentimes it's worth it because they're going to avoid little mistakes like this one. Moving on to the question of the day now, we're going over TERS 3 annuity options. So the question specifically, or statement I guess they put in the form here, was that they're looking to learn more about TERS 3 annuity options, if they make sense, guidelines, and best ways to maximize them. So with Plan 3 money, specifically in Washington State, as far as options goes, you can always move the money out or leave it there. The thing to know is that when it comes to annuity options, you guys have essentially 4 annuities you can purchase. First one we're going to nix right off the bat, that's a private annuity. The only way you get a private annuity is when you move money out of Washington State, you move into an IRA, we move directly into an annuity that you purchase. These are very common when you're working with people that work for insurance companies because they need to get their commission check. So when you take money out, you buy a private annuity, you'll get either some type of guaranteed income, some kind of growth structure that can follow the bells and whistles to make it sound good. And case in point, I'm licensed to do that kind of stuff. And I haven't done one in a very long time because it straight up doesn't make sense. The annuities that the state offers, or in terms of income benefits, far outweigh any type of annuity structure that you have. And if someone pitches you some type of growth annuity, I've done those too. They ain't that great. There's other investments out there that have much lower fees, no commission, that actually are a little more liquid, that produce the same, if not better, benefits. So don't fall for the annuity, this type of special deal. You always want to ask kind of what's in it for them. If it's so great, why doesn't everybody do it? Kind of follow your gut there. So if you get pitched a private annuity as Washington State Employee Plan 3, pump the brakes, do research, call other advisors, get some other opinions on it. Because once you make that move, it's pretty much permanent and it's going to cost a lot of money to get out of. And once you move money out of Plan 3 elsewhere, you're no longer eligible for any other annuity from the state. You should basically shoot yourself in the foot. And I had a prospect come in this past week, retired in August, moved all his money out into an IRA, not knowing that he just lost his right to purchase any type of annuity from the state. Now he's looking for income options, and it's like, well, you just limited yourself from 3 of the best options out there. Now we have to look at, private strategies, not necessarily annuities, but we're going to have to make it work for structuring your investments up properly to produce the income that you need. It would have been easier had he not rushed through this. If he called me before making that move, then we could have maybe looked at these options first, and maybe they didn't work out for him, but at least knowing what you're saying no to before doing it makes a big difference. So the 3 annuity options that you have from Washington State specifically are the service credit annuity, aka buying service credits. You have your plan-based annuity. In this case, it'd be the TERS annuity. So every system that has an acronym has an annuity named after them. Left annuity, TERS annuity, CERS annuity, on and on and on. And then Plan 3 specifically, the one annuity that's unique to Plan 3 members only is the TAP annuity, which is a total allocation portfolio annuity. So when you're looking at those 3 options, it's important to see how much income I'm going to get from them, because they're all income annuities. They all pay out guaranteed for your life. You can name survivors on there. So should I pass away, the income stream continues on for them. If you ever never spend all that money, so you pass away before you spent all that money down, whoever you list as a beneficiary, which is different than a survivor, will get that money as a lump sum. So survivor continues the income stream, beneficiaries get the lump sum. So it's important to compare what the payout is. If I'm going to buy service credits, I can only buy up to 5 years of that. And there's a whole formula on, how much that's going to cost and stuff. Is that cost or how much money I have to put in there going to generate enough income to make it worth it? We're looking specifically as kind of what the rate of return is on that investment. It doesn't make sense. So you have to do some math when comparing those 3 options to figure out what's the best path for you. This is something that we do with our clients, is to help them find what the right path is. So buying service credits is the first route to look at. You can only get 5 years. Basically, you're adding to your pension plan. So if you're in Plan 3, you're basically getting 1% per year that you're buying, or an extra 5% added to your pension. So easy math, if you're top 5 consecutive years, or about $100,000 on average, you're getting 5% of that. It's another $5,000 per year is what you're adding. Now, depending on what that costs you, again, the cost formula is a whole nother issue. I've got videos on YouTube going in detail on that. You got to figure out if the cost is $100,000 or $150,000, how many years is it going to take for me to get my money back? What is the percentage, basically my return on that money? So I'll look at that first. Option 2, we said, was the plan annuity. So if I'm looking at this TERS annuity, what does the payment plans look like on that? So same thing. If I put in $200,000 for my Plan 3 money into this TERS annuity, how much is it going to pay me on a guaranteed basis? One quick side note, when it goes back to service credit annuities here, is you actually can't use the Plan 3 money to make that purchase. So you're eligible to purchase it, but the Plan 3 funds specifically cannot be used to buy them. You have to use outside money, cash, other investments, things like that to make that purchase. When we look at this TERS annuity, it's the same thing. You cannot use your Plan 3 money to buy. You can use other money, 403Bs, deferred comp, savings, things like that, but you cannot use the Plan 3 money specifically to make that purchase. So that leads to the TAP annuity specifically. So TAP annuity is the one that only Plan 3 money can be used for. So service credit and TERS annuities cannot have any Plan 3 money. TAP annuity is only Plan 3 money. So that's one of the biggest differences between them, is what funds can I use to make the purchase. As far as payout rates, last night I did the comparison. TERS annuity pays a little bit more than TAP annuity, and it's just barely more in the beginning. But Plan 3 is usually the one that a lot of our clients go with, simply because I can use my Plan 3 money, which is where most people have their money. And two, the TAP annuity has a guaranteed 3% cost of living adjustment on it. Guaranteed for life is something you can't find out there unless you're paying a heavy fee or taking a big income reduction up front. You can't find that in the private market at all. That 3% is huge. When I look at the TERS annuity, even though they pay a little bit more to begin with, they don't have a guaranteed cost of living adjustment. Their cost of living is based on the CPI index. It can be anywhere from 0 to 3%. It follows the same income increase as your state pension plans. There's no guarantee it's going to go up. That 3% is guaranteed per year. So even though that the state pensions have been paying out their max 3% every year since COVID, 5 years in a row now, at some point it's likely that maybe they won't pay 3%, maybe they'll go 2% next year. That TAP annuity is going to overtake it any time that thing dips below 3%. And so for that reason, once it dips below it, it's not ever going to catch it back up again. So that's one of the other reasons why a lot of people use a TAP annuity for that. Now, the TAP annuity, there is no income deadline on it. It's available to you as long as you have money in Plan 3. So if you retire today, you leave money in that plan for 5 years. 5 years from now, you can come back and say, hey, I want that TAP annuity now. You can move the money in and start that income stream. The other ones have deadlines on them. So service credit and TERS annuity, you have about 60 days after you separate service to make the purchase. Otherwise, the offer is off the table. So if you're going to go one of those routes, you have to make the decision pretty quick to know if you're going to make that move or not. Otherwise, it's gone forever. So those are pretty much all of your options that you have as a TERS 3 member. And to summarize it up, only one of those can be used with Plan 3 money. The other two have to be used with outside money and has deadlines of 6 days after you separate service. Once those deadlines pass, TAP becomes your only option. Once money comes out of your Plan 3 account, you forfeit the TAP for the rest of your life. Then if you ever need guaranteed income in the future, private annuities are your only option, and you're going to be paying higher fees on that for lower income and less guaranteed growth. So this is a super important decision. It's one of the key reasons I'm able to get people out many years earlier than they thought possible, is because we're not afraid to look at these TAP annuities, the benefits, and how they can potentially provide more income than not just private annuities, but just people that want to pull money off the market or dividends or however you want to do it. TAP annuities are built for retirement income. Dividends, income withdrawals from the market are not. There's nothing that guarantees that's going to work out. Yes, maybe you could earn more money that way down the road, but you're going to still have to deal with the roller coasters. Nothing is guaranteed. So TAP annuities should be something to consider before separating service, just to make sure you understand all the pros and cons of it before saying yes or no to it. And just remember that it's not an all or nothing thing. You don't have to put all your money in. I wouldn't even recommend doing that for most people. So you always just put a little bit in just to get some type of guaranteed growth. A common strategy people are using now is putting just enough in to cover their rent, or they put just enough in to cover their medical costs. And it just gives what's one less bill you have to worry about. Like, oh, a lot of people worry about healthcare. Well, if I put just enough in to generate the $1,000 a month that I need to cover my healthcare bill, then that's one less thing I have to think about or worry about down the road. And that can make a real big difference when people are thinking about retiring early. So if you want more insight on this, to dive into the different strategies, the link to schedule a call with us, it was in the description below. Or if you want to go a little bit deeper on this, I have the Washington Breakthrough Community. The link is down below as well. You can join us there to go through the free course, ask questions in the community page, and we're happy to support you along the way. So hope this helps you guys out. I'll catch you guys next time, and remember that your future depends on what you do today. All right, before I sign off, just a real quick legal disclosure that we're required to say as licensed fiduciary advisors. So remember that this is a podcast. It is designed for educational and entertainment purposes only. I don't know you personally, therefore I cannot give you any personal advice. So please don't take anything that we say on the show as being personal financial, legal, or tax advice. If you want that kind of stuff, make sure you seek out a professional so they can help you with the strategies and investments that are right for you. Also, please remember that despite the name of our show, we are in no way associated with Washington State or the Department of Guidance Systems or any other Washington employer. We're a private-owned firm that specializes in working with Washington State employees, which is why we know so much about this stuff. So remember, we don't work for the state in any way, shape, or form, so please don't confuse us as being an official representative of the state. All right, that's it for the legal stuff. I'll catch you guys all next time.